you're not really buying gold. What you're doing is you're buying stability by getting out of credit. I think this is the important point. I mean, it's very, very important for anyone who thinks they're investing in gold. No, you're not investing in gold, because when you're investing in something, and we're all sort of accustomed to look at a price of a share or stock, and we've seen it rise, and we think, are we too late to get in? Perhaps we should wait until it comes back a bit. Doesn't quite come back, and it goes on a bit, and you reassess. And no, this is not the case, because it's not gold rising. It's your currency going down. Is my currency still going down for whatever reason, or has it stabilized? And that should determine whether you have all your eggs in that currency, or whether
a new proprietary Vanguard model estimates that the US dollar is roughly 12% overvalued against a basket of 5 leading currencies heading into 2024. In the coming decade, the probability of some dollar depreciation is at about 75%, with a modest decline of 1.1% annualized as the most likely outcome. As of 2023, the global market size for precious metals is valued at approximately $250 billion. It is projected to reach around $370 billion by 2032, with a compound annual growth rate of 4.3%. Celebrated stockbroker Alasdair Macleod asserts that gold has maintained stable purchasing power for centuries, unlike the S&P 500, which depends on credit for growth. In the 26 times since 1985, when monthly data shows U.S. equity volatility shocks, defined as realized volatility of more than 30%, gold's price volatility was 22 points lower than that of equities. Based on ongoing trends, Macleod explains that while fiat currency prices fluctuate, gold retains its long-term value. For instance, oil prices have been highly volatile in dollars but remain relatively stable in gold. Instead of asking whether gold is too expensive or too late to buy, he advises people to assess whether their currency is continuing to lose value. The US dollar surged to a 3-week high, initially pressuring gold prices, but the underlying safe haven demand ultimately kept gold near its record levels. Analysts at UBS remain bullish, expecting gold to push toward $2,850 in the coming months as geopolitical risks persist. In his analysis, Macleod predicts that Eastern nations, including China, will soon confront the risks of a credit-based system and will need to anchor their currencies to gold. According to jwview.com, a financial media platform under the China News Service, the share of gold in foreign exchange reserves rose from 3.3% at the end of 2021 to 5.5% at the end of 2024. However, recent developments suggest that China's gold demand will be stronger in 2025 than we first thought. Now we present the clips of Alasdair Macleod's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I think it's important to understand, two things. Firstly, you own gold not as an investment. You own gold basically to get out of credit. It's a very, very important point. You're hoarding it. You're in cash, but this is real cash with no counterparty risk. I think that's the important thing. And when it comes to comparing it with something like the S&P, the S&P, the constituents of the S&P actually go out and deploy credit purposefully and productively and profitably. So, you're always going to get use out of credit. You don't get use out of gold. The second point I'd like to make is that the purchasing power of gold is non-volatile. I did a bit of research some time ago. I looked at Diocletian's edict of maximum prices. Now, we're going back to about 302 AD. So this is it's 1800 years ago. And if you look at the prices of things in those Roman times, apart from the slave markets, which no longer exist, so we can't do that comparison, you look at things like, sort of foodstuffs, eggs, you look at beer. Wine has gone down, actually. There's been some fluctuation, but generally, the prices in gold are about the same. And this is interesting. And a colleague of mine, when I was at Gold Money, James Turk, produced a fascinating chart of oil, WTI oil, in both dollars and in gold. In fact, he did it in 4 major currencies. But the point is that in gold, the price just goes along like that. Oh, I think the most I've seen is about it's risen. The price of oil rose in gold by about two times, two and a half times. Um, the worst was it it lost 50% roughly of its value measured in gold. But look at it in dollars, for goodness sake. I mean, it went from I think the 1950 price was something like $2.56 a barrel, up to $140 at one stage. And currently we're looking at 70. I mean, this is the difference. This is the point. You're not um, you're not really buying gold. What you're doing is you're buying stability by getting out of credit. I think this is the important point. I mean, it's very, very important for anyone who thinks they're investing in gold. No, you're not investing in gold, because when you're investing in something, you look at the price, and we're all sort of accustomed to look at a price of a share or stock, and we've seen it rise, and we think, are we too late to get in? Perhaps we should wait until it comes back a bit, and it doesn't quite come back, and it goes on a bit, and you reassess. And no, this is not the case, because it's not gold rising; it's your currency going down. So what you've got to think in terms of is my currency still going down for whatever reason, or has it stabilized? And that should determine whether you have all your eggs in that currency, or whether way around. I think we should learn from the East that gold is money, because the People's Bank from China, for example, I mean, everybody's been commenting how they've been buying gold. No, they're selling dollars. In terms of what lesson they can learn from the West, I think very shortly they'll learn the perils of being entirely based in credit, and they're going to have to protect their own currencies in this credit implosion. And I think that the reason they have been acquiring gold is that they know that they've got to anchor the value of yuan, rubles, whatever it is, to gold at some stage. But they don't want to act ahead of events, because that would just destroy the dollar and create, I mean, it's financially the financial equivalent of a nuclear war, I think, which could indeed end up being a nuclear war. I mean, the consequences, I think, of anyone going onto a gold standard just undermine the credibility even more rapidly of our crazy credit system.
Regarding the current system, Alasdair Macleod explains that fiat currencies are not tied to gold, but reference the US dollar, which he describes as the least dirty shirt in the laundry. He argues that other currencies depreciate even faster while the dollar is losing purchasing power. After China and Russia, Indonesia has emerged to be a new player to advance the de-dollarization agenda and sideline the US dollar. Just recently, Indonesia convinced India to settle payments in local currencies in a new bilateral trade agreement. Indonesian President Prabowo Subianto visited India last week to sign the deal and process payments in local currencies. The two countries agreed to either pay the Indonesian rupiah or the Indian rupee for cross-border transactions. BRICS countries are actively diversifying their foreign exchange reserves away from the dollar. This includes increasing gold holdings and exploring the use of local currencies for trade. Moreover, Macleod notes that the rising interest rates and excessive debt threaten to burst the global credit bubble. At the same time, central banks already in deep negative equity may struggle to stabilize the system during a crisis. Let's get back to the interview.
Basically, all paper currencies, all currencies, instead of being tied to gold, now refer, and they're not tied to the dollar, but they refer to the dollar. So, as Steve Hanke puts it, the dollar is the least dirty shirt in the laundry, which I think is a pretty good analogy. Now, what that means is that the dollar may indeed be weakening, losing purchasing power. I mean, obviously it is, and I would say at a faster rate than indicated by the consumer price index. But other currencies are losing, purchasing power even more rapidly. And I think the which I have to take issue with monetarists, because monetarists just sort of think there's a mechanical relationship between the quantity of money and its purchasing power. The problem with the fiat currency is that its value ultimately depends on the faith that its holders and users have in it. If they lose faith, it's valueless. And indeed, I mean, I think this is sort of admitted in a backhanded way by the U.S. government. It's you're buying the faith and credit of the U.S. government. When you hold dollars. Yeah, exactly. That's absolutely true. And this is independent of the quantity. Okay, the quantity has an effect. I mean, we know that it dilutes. If you issue more dollars, then you're going to dilute its purchasing power. Of course you are. But the overriding thing is the faith that people have in that currency. And it's that which is likely to disappear. Why? Because you're in a debt trap, one. And two, rising interest rates created by the debt trap, in effect, is going to prick the credit bubble. And then nobody wants the credit, any credit. I mean, you don't want lesser forms of credit like bonds or equities or any bit of paper, derivatives. I mean, that's another one. I mean, think of the value of derivatives is just absolutely astounding. So all this is going to suffer, if you like, a huge, great reappraisal of value. And as far as other currencies are concerned, I mean, they are down the pecking order, and I think that's the way to look at it. I would say the other thing, which we haven't mentioned yet, is if you look at the balance sheets of the central banks, they're all deeply in negative equity. I know there's been some publicity about the Fed, as a result of doing QE. I mean, you could define QE as the means by which a central bank pays the highest possible prices ever for government debt, and that's actually what they were doing. I mean, just look at the Bank of Japan's balance sheet. It's something like 40,000, 50,000 times underwater. It is. I mean, everybody thinks it really doesn't matter. But you get a banking crisis, and then you start trying to rescue the commercial banking network by not allowing anyone to go under. Then it's going to matter exactly, if you like, the hidden inflation within the system, because they'll be inflating from already a position of huge, huge, great balance sheet mess.
Gold investments can be worthwhile in 2025. Especially for diversifying your portfolio and hedging against financial instability. As central banks expand their gold holdings, could we see a return to a gold-backed monetary system in the near future? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.